Trump's tax overhaul, immediate relief or long-term burden? Summary: Treasury rates climb amid budget worries. Tax cuts expected to shrink tax income by $4.5 trillion over 10 years. Potential for rising corporate profits and stock values. New York, July 3rd. President Donald Trump's recently approved tax reduction and spending legislation, which gained congressional approval last Thursday, provides the U.S. government with a temporary financial breathing space, yet could intensify the nation's escalating debt issues. The tax cut package, embraced by House Republicans, continues Trump's 2017 tax cuts, approves additional spending for border security and the military, implements significant cuts to Medicare and Medicaid, and ultimately increases the debt by trillions. It's anticipated that Trump will sign the bill into law shortly. To address the increasing debt ceiling, the bill raises the federal borrowing limit by $5 trillion, postponing the predicted deadline, or X-date, when the Treasury would run out of funds to meet its obligations, which experts had projected could happen around late August or early September. Although the immediate fiscal relief is welcomed, the long-term outlook for the U.S. bond market and financial stability seems bleak. Nonpartisan analysts project an additional $3.4 trillion in national debt over the next decade, raising alarm over increased bond issuance and reduced demand for U.S. treasuries, which have played a pivotal role in recent financial market dynamics. Could this bill inadvertently destabilize the treasury market? Mike Medeiros, a macro strategist at Wellington Management, raised two major points of concern: the ongoing fiscal deficit and elevated national debt levels, and the potential inflationary impact. But here's where the controversy kicks in. BlackRock has issued a warning about the declining interest from foreign investors in American debt. They caution about the rising risk that the demand for the $500 billion in weekly UF debt sales could continue to decline, possibly resulting in higher borrowing costs for the U.S. government. The projected figures show a staggering $4.5 trillion reduction in tax revenues over 10 years, alongside $1.2 trillion in spending cuts and the loss of federal health insurance for 10.9 million people. However, the legislation also has a silver lining. It incentivizes economic growth by allowing businesses to deduct the full expense of equipment purchases and R&D costs, among other tax benefits. But this is the part most people overlook. Some investors are concerned that the expected benefits could be offset by the accumulating debt's impact on the economy. Campe Goodman of Wellington Management predicts that the bill may boost economic growth by 0.5% next year, but warns that the market is underestimating the long-term risks of increased borrowing costs. What are your thoughts on this fiscal strategy? Do you believe that tax cuts and spending will stimulate sufficient growth to counteract the negative effects? Or do you worry about the escalating debt burden on future generations? Share your thoughts in the comments below.